What are bonds? Bonds are strong connections between you and someone of value. Hold up. There's more than one definition. You're here to talk about investing, right? Not building a better relationship with your loved ones. We gotcha. 5, 4, 3, 2, 1. Let's invest. Step 1, do your research. Yes, I will say it many times throughout this series. The question, what are bonds, seems to be the most difficult question to answer according to the many videos and articles on the internet. They seem to be when you as the investor loan a borrower, which would be a company or entity, money that they pay back over time with interest, similar to a title loan. But the roles are reversed. You're the one behind the desk, resulting in the company or entity paying the balance and interest to you. However, depending on your perspective, this concept may be the most easiest thing for you to grasp. There are 6 different categories of bonds, such as Treasury and agency. Each have specific systems for receiving bonds. Treasury bonds can be bought directly from the U.S. Treasury through its site. Other bonds have to be bought through an online brokerage. Try to be mindful because they may be fees. Ask around to find the pricing that works best for you. Also, there are a few key terms to keep in mind throughout this process. Issuer, maturity date, face value, coupon rate, bond rate known as credibility or creditworthiness. That means always research the borrower using credit ratings. Callability, zero coupon bonds. These terms will be used while working with bonds. Step 2, how to choose bonds. Before you choose a bond, it might be best to look at the state of the economy, specifically the Federal Reserve. They set the interest rates known as federal fund rates, which will play a major factor in the value of your bond over the maturity date. Bonds have an inverse relationship with the federal fund rates, meaning when the interest rates rise, the bond's prices usually fall. It is recommended to study the 10-year Treasury yield to build your portfolio. The best bonds for your portfolio are the ones with investment-grade credit ratings. Stay away from those considered a junk bond. That means their ratings fall below C. Another important factor to look at is their yield. The yield is the return you will be receiving for that dollar amount invested. The higher the yield, the more you get for what is invested. However, higher risk comes with that. Everything that sounds good is not always good. Your bonds should be used to diversify or add stability to your portfolio. Most investors use bonds with stocks in their portfolio. Your risk tolerance will help you decide the road you take. As the days get shorter, the stock market may be too fast-paced for you, increasing your chances of downsizing your shares in the stock market. To replace them with bonds that create a constant grow on your money, you have many tools at your disposal. Do right by your portfolio and yourself.